Welcome to Phillip Mastermind. My name is Kim. Chinese equities performed well until May this year, but then experienced a sharp correction due to weaker than expected economic growth, low consumption, challenges in the property market, disappointing PMI figures, and a high youth unemployment, all of which have dampened market sentiment. Since the beginning of the year, Chinese policymakers have been actively implementing various measures, including state-owned funds buying and initiatives to encourage spending, particularly in the real estate sector. While these efforts have provided some support, they have not been sufficient to fully stabilize the market. Sentiment towards Chinese equities has seen a dramatic turnaround since late September as the authorities unveiled a range of supportive measures that included interest rate cuts, free up cash for banks, and liquidity support for stocks. On September 24th, the State Council held a press conference attended by key officials, which include the Governor of the PBOC, Director of the National Financial Regulatory Administration, and the Chairman of the China Securities Regulatory Commission. Then, on 26 September, China conducted an unscheduled Politburo meeting to discuss the economic policies chaired by President Xi Jinping. Historically, such meetings are typically held only in April, July, and December. The meeting focused on implementing existing and new policies to enhance economic effectiveness. Key strategies include adjusting monetary and fiscal measures, stabilizing the property market, boosting capital markets, promoting consumption, prioritizing employment for vulnerable groups. As a result, the CSI 300 and Hang Seng Index experienced a significant rebound after more than 3 years of underwhelming performance. We are of the view that China's policy announcement on September 24th and 26th represent a significant shift in the country's approach to policymaking. First, the wealth effect from stocks and property has now gained the attention of the policymakers. Second, there's a clear intention to stimulate consumption through direct subsidies aimed at addressing insufficient domestic demand and the structural imbalances between supply and demand that have contributed to the disinflationary pressures. Of course, the rally in Chinese markets lost momentum when trading resumed following a week-long holiday, as a briefing from the National Development and Reform Commission offered limited information on additional stimulus measures. While the China CSI 300 skyrocketed over 10% at the open Tuesday in its return from the Golden Week holiday, the index paired gains to a record gain of 5.9%. Hong Kong Hang Seng Index briefly declined over 10% before recovering slightly to a smaller loss of 9.4% as of its final hour. As of October 8, valuations look fairly reasonable. The CSI 300 index is currently trading at 2024 PE ratio of 13.33 times, which is 0.6 standard deviation above its 10-year average. However, its price-to-book ratio is at 1.62 times, half a standard deviation below the 10-year mean. Meanwhile, the HSI index is trading at 2024 PE of 10.49 times, roughly in line with the 10-year average, while the price-to-book is slightly above the average of 1.24 times. These suggest that the current valuation has largely priced in the positives. For more sustained recovery, we believe the policymakers will need to actively leverage the fiscal policies and implement strategies to purchase excess housing inventory more decisively. In addition to that, the country must tackle the structural issue through both substantial fiscal measures and reforms. Finally, an upwards earning revision is also a catalyst that's still on the horizon. All eyes are now on the outcome of the US presidential election. As such, we are holding a cautiously optimistic view on the market. Investors are closely watching the job market issues such as the Hamas-Israel conflict, tensions between Iran and Israel, and the situation in Ukraine. We are also paying close attention to global inflation trends, US 10-year bond yield, forecasts for global economic growth, and movement in interest rates worldwide. That said, we reaffirm our belief that there are still opportunities in the market, and we maintain a discerning approach in choosing high-quality stocks for our portfolio. However, it's crucial to exercise caution and carefully select investment options to ensure the best risk-adjusted return. By taking a vigilant and discerning approach, investors can potentially reap the benefits of the current market opportunities while minimizing risk. A noteworthy avenue for investors seeking diversification in their portfolio is through Phillip Capital Malaysia. Phillip Capital Malaysia offers multiple private mandate services managed by professional fund managers. By leveraging Phillip Capital Malaysia's private mandate services, investors can enhance, optimize portfolio performance, and navigate the complexities of the market with confidence. Apart from our inaugural private mandate services, we also offer unit trust funds, PGWA, that could cater to different investor needs. That's all for today. Stay tuned for our next Phillip Mastermind, where we will examine the US presidential election and share updates on positioning after the election. This update is brought to you by Phillip Capital, your partner in finance.